Target Corporation has been on a roller coaster over the past few years. During the pandemic, the stock soared as consumers rushed to buy essentials and invest in home improvement. But since peaking in late 2021, the share price has steadily declined, falling more than 45% from its highs. Now trading below 140, investors are asking, is this a buying opportunity or a company in structural decline? To answer that, let's take a deep dive into the business, starting with the current market environment and how it's affecting Target's performance. Target's recent struggles aren't entirely company-specific. The retail sector as a whole is under pressure from multiple angles. High inflation, elevated interest rates, and student loan repayments have all combined to hit the middle-class consumer hard, especially the younger demographic that tends to favour Target over competitors like Walmart. Discretionary spending is being squeezed, and that's critical for Target because a sizable portion of its revenue comes from non-essential items like clothing, home decor, and seasonal merchandise. These are the very categories where consumers cut back when budgets get tight. Now, with inflation beginning to cool and the Fed expected to cut interest rates later this year, there's light at the end of the tunnel. But until we see sustained improvement in consumer confidence and spending habits, the pressure on Target's top line could linger. Target remains a $65+ billion company with a massive physical and digital footprint across the US. It operates over 1,900 stores and has built a strong omni-channel presence through services like Drive Up, Order Pickup, and same-day delivery through Shipt. But here's the issue. Growth has stalled. Comparable store sales have declined in multiple quarters, and revenue has remained essentially flat or down on a year-over-year basis. Gross margins have improved slightly after a tough 2022, but that's due in part to aggressive cost-cutting and inventory optimization rather than organic sales strength. Target's balance sheet is still relatively solid, with manageable long-term debt and consistent free cash flow generation. But its capital allocation priorities, such as share buybacks and dividends, may face limitations if margins continue to stay under pressure. Valuation-wise, Target is trading at around 14 times forward earnings, which is below its historical average. That might seem attractive on paper, but there's a reason for the discount. The market is pricing in uncertainty around consumer behavior, ongoing retail competition, and the company's ability to return to sustained growth. On the technical front, the picture isn't promising. Target has been in a clear downtrend for over 2 years now, forming lower highs and lower lows. It recently broke below the $112 support level, a zone that had previously acted as a floor. That line has now become resistance. The stock remains below its 50-day and 200-day moving averages, and both of those averages are declining, classic bearish indicators. Volume on down days has generally outweighed volume on up days, suggesting continued distribution by institutional investors. The Relative Strength Index, or RSI, is approaching oversold levels, which could point to a near-term bounce. But unless we see a strong reversal pattern or bullish divergence, any rally is likely to be short-lived. Technically, this stock does not have strong momentum behind it, and that makes new entries unattractive right now. Target is not operating in a vacuum. It faces fierce competition from multiple directions. Walmart is gaining market share, especially among price-sensitive shoppers. Its grocery business is massive, and its scale gives it a cost advantage that Target simply can't match. Amazon continues to dominate online retail. While Target has made strides in e-commerce, it's still a distant competitor in logistics, convenience, and digital infrastructure. Costco has been outperforming with strong same-store sales growth, high renewal rates, and a resilient, value-oriented membership model that's weathering inflation far better than discretionary retailers. Dollar General and Dollar Tree are capturing the ultra-price-sensitive demographic, consumers who once shopped at Target but are now trading down. Target's unique brand identity, a blend of low prices and trendy appeal, is being squeezed from both ends. By discounters offering lower prices and by premium retailers offering a more upscale experience. To its credit, Target's management is taking proactive steps. It's investing in remodeling stores, expanding private label offerings, and doubling down on same-day services. The company is also working on right-sizing inventory to better align with shifting consumer habits. But even with these efforts, growth has not materialized. The initiatives haven't yet translated into meaningful margin expansion or revenue acceleration. Management also faces a tough balancing act. cutting costs while maintaining the Target brand experience that differentiates the company from more utilitarian competitors like Walmart or Amazon. There are multiple risks facing Target right now. Consumer weakness is a primary concern. If inflation persists or unemployment ticks up, discretionary spending will be further constrained, and that's where Target is most vulnerable. Target has also faced backlash over social and political issues in the past year, which has alienated some customer segments. While the long-term impact is hard to measure, it's a real reputational risk in today's polarized environment. Unlike Walmart or Costco, Target lacks a defensible pricing moat or membership-based loyalty program. If it can't distinguish itself through merchandise or digital convenience, it risks becoming stuck in the middle, a dangerous place in retail. Lastly, inventory missteps and weak holiday seasons have already hurt the company. A few more quarters of underperformance could permanently damage investor confidence. For long-term investors, Target is not a strong buy right now. While the company is stable and the dividend is safe for the moment, the lack of growth, ongoing competitive pressures, and weak technical setup make it more of a hold than a fresh entry. If you already own shares, it makes sense to continue holding, especially if you're reinvesting dividends and have a long time horizon. But for new investors looking to deploy capital into the retail sector, there are stronger opportunities available today. Costco. Costco is executing at a very high level. It benefits from a membership model that provides predictable recurring revenue. Same-store sales remain strong, and it continues to attract consumers looking for value. Despite a higher valuation, the premium is justified by superior performance, strong financials, and consistent growth. Walmart has shown resilience through inflationary cycles and is gaining share in groceries, healthcare, and even digital advertising. Its e-commerce business is growing, and it offers scale advantages that protect margins. It's more defensive than Target and better positioned in a downturn. If you're looking for exposure to discretionary spending with a more resilient model, TJX Companies, the parent of TJ Maxx and Marshalls, is worth a look. It thrives in uncertain economic environments thanks to its off-price business model and treasure hunt appeal to value-conscious consumers. And though not a traditional retailer, Amazon remains a dominant force in e-commerce and logistics. With growth resuming in AWS and operating margins improving, Amazon offers both a tech and retail play wrapped into one. Target isn't a broken business. It's still a well-known brand with a loyal customer base and decent fundamentals. But in today's market, that's not enough. With stiff competition, consumer headwinds, and weak technicals, Target doesn't offer the risk-reward profile investors should be seeking right now. The recommendation is to hold or avoid initiating new positions for now. Re-evaluate after signs of bottoming in the stock price, improving comparable sales, or a clear macro recovery in discretionary retail. Until then, investors are better served allocating capital toward better positioned names like Costco, Walmart, or Amazon. If you found this analysis helpful, please take a moment to hit the like button. Leave a comment below with your thoughts or questions, and don't forget to subscribe to the channel for more in-depth stock market insights. Your support really helps me keep delivering detailed, honest content that can help you make smarter investing decisions. As always, this isn't financial advice. Do your own research, assess your risk tolerance, and consider how each investment fits within your broader portfolio strategy.